Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, January 17th, 2024. It is 11:19 a.m. as I'm starting the video, so we're a couple hours into the trading day. And here's what we're going to do in this one, and I'll try to keep it in this order for you in case you want to skip ahead to something. We'll cover the equity markets, and by that I'm going to cover the main indexes I usually cover, and that's the S&P 500 via SPY, the NASDAQ 100 via QQQ, and the Russell 2000 via IWM. I also want to do an update on the semiconductor stocks. There were a couple of questions and comments there, and it's a big sector in the tech sector. In fact, one of the subscribers recently asked if I could cover it more often. And I'm keeping an eye on it, and I will. I'll update it here, and I'll try to do it ever so often. So we're going to do that. Time permitting, I'll touch on the VIX because it's certainly related. It's pretty much moves inversely to the stock market. Had some requests, another request I just saw for an update on the precious metals and miners, so I'll cover that. Here's what I'm basically doing, the big three, and that's stocks, the euro US dollar, which is really, the key to trading gold and silver. If you can see where the euro and the US dollar are going, then you know where gold and silver are going. And then the other, the big three are Treasury bonds. And so the theme that I've been harping on, I continue to see develop, which is yields ticking back up, and the market, in my opinion, dismissing it so far as, and it may be that, it may just be a little blip, a little counter trend move. But again, I'll get to that when I talk on bonds. I'll expand on that a little bit more, and again, how that may impact the stock market. Okay, starting out here very quickly, no need to spend a lot of time on it. This is the S&P 500. I should mention, we had a post in the comments section. One of the members of the site mentioned, the big double top, potential double top. What I said is, yeah, they'll, if it pans out as such, which I suspect it will. Again, you can see here with these indicators lagging, the divergences are in place. Even if we pop it, which really wouldn't surprise me one bit, I almost could flip a coin and say whether we're going to pop it, get that marginal new high scenario or not. But as I often say, again, this is from years of experience, breakouts that occur with overbought conditions. And you can see on my SPY chart below, this is a daily chart we're looking at here. If I don't make mention, you can see it up here. The time frame, or right there, that little blue box with the D, so you know which time frame I'm, because I always jump around. And on SPY, I do this with every security. Overbought to me isn't just what the generic settings are on any charting platform. Most all charting platforms, when you populate an RSI, is going to give you a line at 70 is your overbought level. That's the red line down here, and then a 30 level for oversold. And I always analyze every security on its own, because many securities, you take natural gas, for example, or some high-flying tech stocks, they hit 70 and they don't, it doesn't phase them. In other words, they tend to get more overbought, more oversold. And again, every single security, every single index is different. And so therefore you can see on SPY, at least in recent years, I put my overbought line at 77. That's about what does a trick. Again, here I'll zoom in and you can see it. So that's where you typically get before the rallies are capped, or reversals come shortly afterwards, whether they're corrections in an uptrend, just a pullback, or a major trend change. That's really a level you want to note. So we're coming off that extremely overbought reading there. And we also have negative divergence. And again, it's been my experience that much more often than not, that's not 51%, 55%. It's well up in the 80% plus range, where breakouts that occur with negative divergence and overbought conditions have a very high rate of failing, meaning they don't go very far and then they fail. And you want to take it on face value. I always say this: a breakout on face value is bullish. A breakout to new highs, it is always bullish until and unless it fails. So you don't necessarily short the breakout. What you do, if you want to play it safe, you wait to see the breakout fail. Or if you're an aggressive trader, you can short it. I quite often do that. If I have a high degree of confidence it'll fail, I'm an aggressive trader with a stop somewhat above, just in case it keeps running. Over the years, if you traded through 1999 and dot-com bubble and other things like that, you'll learn that sometimes overbought just keeps getting more overbought. So be careful there. And again, that's the S&P in a nutshell, and where I think it's going. And then again, my targets have not changed. Longer term targets that I've laid out when the S&P first peaked back here in late 2021, early 2022. I gave you some near-term targets, all of which were hit. A long-term first target and then a long-term second target down here. In this one here, long-term T4. These are all targets I maintain for the next leg down. I think will be hit in 2024, no later than 2025. And you can see I've even added a pretty aggressive one all the way down here. That would take us pretty much back to the COVID lows. I doubt very many are calling for a drop like that. Maybe we get it, maybe we don't. And 6 months from now, I may be singing a different song. But right now, and all along, that's where I see us going. We'll see where we go from there. But short term, this is the 60-minute chart. This is what really controls my positioning. I'm not positioned for what I think where we're going to be in 2 years from now. If I was, I'd be an investor more. I'm a swing trader. I don't like to ride out, 10% double-digit moves against my position. Sometimes in certain accounts, if I will tuck away things, and I certainly don't trade as actively in longer term accounts, IRAs, and things like that. But this is where really my positioning, especially my active trading account, will come from what this chart tells me to be long or short. So we had a divergent low there, that's bullish, and there's a divergent high. We had a sell signal breakdown of the wedge. We hit support right here, 468.15. Bounce back, and all we did is make a ever so slightly marginal new high, which has so far failed, or at least we had a reversal off there. But this is still a big number, about 468. I'll even set an alert to it right now. I'm going to pull it down just a hair. Let me know when that level goes at recent low. I think that'll open the door. I don't see, this is a very thin zone here on the 60-minute. I would put good odds that once we take that out, 468 with conviction, we run right down there to 459, and then I would also put very good odds that we have a bounce. So this is swing trading, active trading. That's SPY. Let's look at QQQ before I leave SPY. Remember on the weekly chart, this is what it looks like here. This is the previous high. We're right there right now. So effectively, we have a double top, but it's not put in yet. If we reverse, the media will be talking about that and all that down the road. But if we pop it, like you can see here on my divergence lines, any new high anytime soon, as long as it's just a marginal new high, not a double-digit plus high, is guaranteed, 100% guaranteed to be a divergent high. And so remember, divergence is not a sell signal. I'm going to address that later. A couple comments lately I saw on the site about divergences. Seems people get angry when I talk about them. But I'll say this once, and if you followed me for a while, you've heard me say this 1,000 times, if not more. Divergences, be they bullish or bearish, negative or positive divergences, are not buy and sell signals. Not at all. Just like overbought and oversold is not a buy or sell signal. They're merely conditions at that time. They are conditions that are indicative that a trend reversal or trend change is likely and imminent. Imminent being, relative to the time frame you're trading. On a 5-minute chart, imminent means minutes, hours, usually not more than a day or two. On a weekly chart, imminent could be months, sometimes even a year. So keep that in mind too when I talk about imminent. It's all relative to the time frame you're trading on. Okay, so that's SPY, and like I said, any new high guaranteed to be still a divergent high, and it would actually be more a bearish longer term to see a breakout because it would suck in new money. The cheerleaders would be flooding out on CNBC with their pom-poms, the market cheerleaders cheering the new highs in the S&P, solid breakout and all that. And that would tend to suck in a little bit more of what we call hot money, money chasing the breakout. And then to see it fail. Again, it's the failure that's bearish, not just the breakout. So if we see it, which I put was good odds. And I say that because, just a failure at the previous high in itself would be bearish, especially, if it's a solid, failure and we clearly move lower. But that breakout to new highs would be even more bearish Why? Number one, because you have shorts that get blown out. They say, okay, when we just broke out to new highs, I'm going to cover my shorts. So they're out of the market. You have lower short interest that clears away for a bigger drop. Plus, you have, again, like I said, hot money comes in that buys a breakout. And then, if they're trading like they should, if you buy a breakout, and that's the reason for entering, then your stop should be on the other side if the breakout fails. That's how typical traditional traders will trade. Alrighty, enough on that. QQQ, same thing. You can see it, effectively here. Same thing, double top high, ever so slightly. If you want to zoom in, whether we're right there. We're at the same thing, double top high, and nothing's changed for weeks and months now, nor will it. This is a weekly chart. We have the most clear and obvious, the kind of divergence I like to see with clean separation on the peaks, a nice trough between RSI down here, PPO, and the last time we had a divergent high on this weekly time frame on QQQ and SPY was back here when the market topped. So that's it. Nothing's changed from my outlook because nothing's changed in the technical posture of the market. Same story. Any breakout anytime soon. Again, if you're not talking, basis points, I'm talking a breakout 2, 3, 4%, will still be a divergent high, and it will still be coming off overbought conditions. We had pretty deeply overbought conditions recently at that previous high. And that's what tends to happen too with the, keep in mind when I talk about that, it's the all the better when you get the divergence. We were overbought, even more overbought here, had a pull back and another thrust up, and all the better when you had the extreme overbought reading and then a lower overbought reading. That's what gives you the negative divergence. That is, again, it's simple, guys. These are momentum indicators. That's why I talk so much on them. It's such a big part of my trading. It's just showing you the momentum is waning. And so, and I have to address this because I know it's only a handful, but I see the comments and people are like, oh, these divergences. But started the beginning of 2022 bearish and short, clearly bearish and short, calling for that because of the divergences. I was clearly bullish and long in the beginning, covering shorts right in the beginning of 2023, bullish and long. Sure wish I, would have personally kept it and just, stopped trading and traveled around the world for the year and stayed long, but I didn't. Either way, it doesn't matter. I caught the bulk of it, initially, and had plenty of trading long and shorts in here recently, and I'm going to get to that in 1 second. And so that's it. So started the year here bearish, longer term, intermediate term bearish here, long. Looking for a decent counter-trend rally overweighting the FANGs and big tech, Mag 7. And here, same thing. We're starting the year like we were back here because the technical posture is almost identical. Because everything, a lot of metrics that I use still say this is a bear market rally. Doesn't matter to me if one index or a handful of stocks made new highs. The majority have not. The majority of sectors in the S&P 500 have not. So therefore, collectively, the stock market, all its, on aggregate, its components have not made new highs, and therefore, I'm still viewing it as a bear market rally. And even if they did, made a marginal new high, then, all intents and purposes, double top. If you add in inflation, adjust the returns of the market, because a dollar, they say now, is worth, it takes a dollar. I've seen measures about $1.30 at minimum, even by the government's numbers. It's a dollar back here it's now takes $1.20 to buy. So if you adjust that down, you're really way behind, even if you rode that out in the stock market on inflation adjusted returns. All right, that's that. Let's jump down to the daily and 60-minute charts. QQQ, very much a divergent high recently, with that trend line break right there, the wedge, sharp sell-off beginning of the year. I identified the sell signal right here. We went down. We hit T1 was right here, but that was when we hit T1. Gosh, where was it? On the futures. I made a note at the time. We had the trend line hit on the futures. We had a bullish falling wedge there. Positive divergence here. This is a 60-minute. This is a swing trading time frame. So this says sell signal right there. We had that drop. wait, that was the first target. Yes, on QQQ right here. I'm sorry. This is when the next target was hit on the futures. Then we had the trend line break. Boom, move down. Bullish falling wedge. Rally up. Divergent high again. We're falling. And so I gave you a level a minute ago on SPY that needs to go. The level right here is about 404 on QQQ. You can see that seems to be the magic number. If and when it's taken out, we'll go down here, hit that T2 on the QQQ 60-minute chart. And that will also, if so, remember, that has a lot of implications because it might seem, oh, okay, well, that's not much, Randy. You're talking another, off this recent divergent high. If we drop there, it's only about a 5% drop. But what it does gets us down to 392, if so, and that's going to take us down here below this. And this whole breakout right here above the recent highs in QQQ will have failed, and that's going to be bearish. You probably have a lot of long side traders with stops down there, so it could have longer term repercussions. This is a big level too. I just want to point it out if and when we get there. So on the daily, you can see right here about 395, really 392, but then right here, it's about three. I have it at 383.61. It's this trading range here. You have a reaction low, you have reaction highs back here. Big level, and so that would be, I'll color it up, and I don't want my charts to look like a Christmas tree, but I've been putting different colors to kind of signify more significant or important support and resistance levels. I think that's a big one right there for QQQ, and then the gap below it, I don't know why I moved that line. That was a bearish crossover or something. Let me just put it right here because you see you have a gap there as well. So if they take out 380, 361, they're going to enter the gap, and the next logical support would be the bottom of the gap. I'm referring to the gap right here, the gap from November 14th. And then, boom, you get down there, you're going to have taken out some of the key short-term moving averages, and you will most likely run down to the 200-day moving averages, which are down here. And then, of course, this whole thing, this is lights out still. I have those purple levels on the thing. This trading range that we've had here, if and when the market drops down through there, that's where I would put extremely high odds, again, when we take out this whole zigzaggy trading range here, that my next targets on the daily chart, which have been here for a while, all the way back here. We had T1 hit right there, T2 hit here, then we'll go down to T3, T4, 5. Pretty fast, and then that's also going to open the door because we'll have this failure here at the highs on the SPY and QQQ. Again, I'm going under these assumptions. We're looking out ahead. That's why I call the right side of the chart. I don't care what happened today, yesterday. I'm taking what happened yesterday and today and trying to extrapolate or predict where we're going to be tomorrow, next week, and next month. That's how traders make money. You got to get in front of these moves. I'm a trend predictor, not a trend chaser. There are trend traders, they call themselves. They follow the trend. It works great until it stops working, and their little method is to buy pullbacks, buy the dip, and then what happens is they start, they've been ingrained in buying the dip. They buy this dip, and they average more. They put more here, and they keep buying the dip, and then finally when they stop out is usually when you get the counter trend rally. So, everybody's a genius in a bull market. That's what the old saying says. It's in choppy sideways markets and bear markets where flexible traders really shine. Alrighty, that's QQQ. Again, just to zero down to the 60-minute chart, I gave you the level. I'm going to move this line right now, guys, to right here. And I'm doing that because not only, most importantly, it's this most recent reaction low right here, about 40, we'll call it 403. Yeah, I need to go down a little bit more. Right there, 403. Why? Because you also had this one right here. So this is the big level. I'm going to set a price alert, and that should do it. That should get us right down here to 392. So if you short a break of 403, set an alert, add it to a short. That's only 3%, but it's for an active trader, that's well worth it. Get in there, come down, probably bounce off that level. Again, look at everything collectively at any point in time. If I plan to, whether or not I game a bounce at 392 will depend on what SPY is doing. Is it also coming up on support? Apple, Amazon, Meta, Facebook, the whole, or all not Facebook, Meta is Facebook, Alphabet, all of them. The more coming to support, and the more the shorter term charts indicate a bounce is likely, the more likely I am to reverse, meaning cover that short and play a little bounce long. Or, if charts tell me, maybe just sit tight and hold out for the next drop. Okay. Something I mentioned recently, to me it was very big. This is a great example. I was crystal clear back here that the NASDAQ 100, the IWM, the Russell 2000, that's a small cap index, that if it broke out, that it would be a marginal new high and that breakout would fail. And I said it the same thing as I'm saying now with the S&P 500. I said it with a high degree of confidence, and that's exactly what happened. This was a massive breakout. We had, again, we're going back, this is a multi-year, year-plus trading range right here. It's a beautiful, just, turn off all the lines and, you can see it. This has been the small caps going up, down, up, down, up, down. There's my arrow tool. There it is. Up, down, up, down, up, down, up, down, up, down. And then you can see, I'll turn back my lines. The top of that range, especially the most recent highs, was right there. And I covered this for you in a video. I showed you why that breakout would have most likely failed. Well, you had the almost identical conditions. This is why I do what I do. This is why I prefer to do these videos, because I can cover a lot more, and talking about this, because there's a lot in the chart. So you have the extreme overbought reading on IWM. 76 is my magic number, again, in recent years. If you watch a video that I'm doing 2 years from now, or one that I did 2 years ago, I probably had a different level there. In different market conditions, every security, every index will have a different ceiling on the RSI and a different floor. And so learn to adjust. So in other words, don't put 76 and just, if 2 years from now, 83 is that magic number, or 69, that's where it is. So, but this one, boom, 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 that hit the 70 level. It was still technically overbought. It was 70. That one came a little bit below there. And then you couple that with, as I said a minute ago in the beginning of the video, divergences are not negative divergences are not sell signals. Neither is overbought. What is? You can look for things such as trend line breaks, bearish or bullish chart pattern breakouts, price support level breaks, or breakouts above resistance if you're going long. But in this case, I gave you the PPO, very highly effective, coupled with wait for your overbought conditions, followed by the sell signal comes on the bearish PPO crossover. There was one, what I call high level. It's got to be well above the zero line. These are all the high level bearish people, and there it is. So the last video, I didn't even add it yet, but I'll do it now. I take that purple line, and that was it. And again, this was laid out in advance. So had you waited and then shorted the bearish PPO crossover, your sell signal, which is also when breakout failed, so far you've made about 5.5% on an IWM short. And as I said back then, and I'll say again, when you have a failed breakout, even when you go to the top of this range, history has said when you go to the top, the next step is the bottom of the range, or very near the bottom of the range, right? So we failed this. So my guess, or my prediction was and still is, that we'll come to the bottom. And because we've had this false breakout that probably sucked a lot of, for the same reasons I said, a lot of new longs in that bought the breakout. I remember the cheerleaders on TV, the market cheerleaders talking about the small caps and how they were going to rally because the Fed's going to be cutting rates, and small cap stocks are much more sensitive to interest rates, which they are, than large caps because they're more dependent on borrowing. So that was super bullish. Buy small caps, and it failed. So there's a lot of retail, or aka dumb money. No offense to anybody. It's just a term for retail investors, institutional investors, or the nickname the smart money. But then dumb money buys, and then they will start to. They're also the weak-handed traders, and they'll start to sell. And again, it blew out a lot of shorts in the small caps. Trend line was broken, so if you didn't take the PPO crossover signal, you took the trend line break that I had, and that's it. And now we've broken this support level as well. So Anyway, that's it. Nothing goes down forever. We're down, what I'd say, 5.5+% off the highs. Pretty straight drop. There'll be bounces along the way, but unless they take out that previous that high, then my outlook remains the same. 60-minute chart, IWM. This is where, again, you can get ahead of the failed. Like I said, if you want to be very conservative when you see a breakout, you can wait till it fails to short it. Or if, like I said, if you had a very high degree of confidence, as I did, that the breakout would fail, then you could align. There's your sell signal. You had a nice little bearish rising wedge right there. Boom, you were right in at the highs, and that probably came right around or right after, shortly before that bearish PPO crossover. And again, that gave you so far, I don't know where I come up with the 4. It's a 7, almost 8% drop. I must have been looking at something else from that high right there. And I'm not from the very high, from the sell signal, from the wedge breakdown. You would have made 7.5, almost 8% so far. Again, nothing goes down forever. I would be remiss not to point out we do have some bullish, aka positive divergences. So something to watch. Resistance. You can see I have a line right here, and then big resistance. So this divergence might bring us up here. Again, I wouldn't be, at this point in time, it's not objective to enter if you didn't enter here. Here you had a lot of opportunities to enter. I think if we get it, we may not get it. Usually these failed breakouts are pretty bearish, and they don't let the longs out, and they don't let the shorts in. That's been my experience. Not always, but a lot of times. If they do, if you want an objective short entry, I would love to see for that a kickback to 190, almost. I have it at 196.72. You always want to sell a little shy of that. You don't want to. The sellers will probably step in early there, but that would be a very objective short entry or add-on or re-entry for IWM. Okay, and for those new to the site, I can't go over every little thing I've covered recently, but I'm kind of trying to throw most of the salient developments into this video to just kind of recap both long and short term. So that's what I'm doing here, guys. I'm starting out on a lot of these on the weekly time frame, kind of painting my big picture, that showing you what formulates my bigger picture, and then drill down to the 60-minute charts, because that's where the timing's at. I make a bullish or bearish case on a weekly chart. That doesn't mean at that point in time it's objective to go long or short. You want to really hone in your entries and exits and time those with the shorter term charts, the daily and or 60-minute charts. But this is big picture stuff, and this is up here. This is the VIX Volatility Index. This is where up until the in the late 90s, early 2000s, that's where previous bear markets ended. This was the dot-com bubble burst right there. We already had high volatility leading up to that, and then it ended. There was the end of that bear market. It was 2002, and so that's where bear markets ended. That's where the VIX would cap out. Since then, we entered a new era. We had the global financial crisis, GFC they call it back there, the bear market. The VIX, right before the bear market started, shortly before that, reached new all-time lows, record lows. There's just no fear in the market, and that's one reason you had such a big drop. And everybody's bullish. What happens is the last one, and again, I'm speaking metaphorically, not literally, but when everybody's bullish and singing the bull song like they've been, I haven't seen that degree of bullishness. Really, I can't remember since back to like 2000. I don't even think it was that bad in 2007 before the global financial crisis, but I'm talking about just recently, leading up to the end of the year. These analysts were just marching out, and the forecast coming out of the big firms was 2024 was going to be a great year. The Fed's going to lower rate, but the economy was still strong. There was no recession. The whole no landing thing was baked in the cake. There wasn't even very few whispers left, heading into the end of December, even about a soft landing. I'm still looking for a hard landing. That's never changed. Anyways, and that's one reason. And again, because if everybody, and again, metaphorically, not literally, when everybody's bullish, the last bull has bought his or her last share of stock, who else is left to buy? Nobody. And again, it's it's speaking generally, but what you can look at, there are measures that show you how fully invested mutual funds are, the amount of cash they have on hand. Typically, back in the day, I don't know what it is now. It used to be about 3%. They would keep on hand for redemptions and new purchases, but. So there are those metrics, and again, you can just kind of, and I've showed you the sentiment polls and the surveys and everything leading up, hitting extremes. So, and that's where we were back here too in 2018. We had that big Q4 drop. We profited. We nailed that one short, got long, covered at the bottom, went long. And but this is since then where I wanted to go is since really for decades now. This is where bear markets, that's the last real bear market, in my opinion, that we had, the global financial crisis, October of 07 to March of 09. And it ended with the November lows. That's actually when the NASDAQ bottomed in November of 08, and everything else was in 09. But so that came right before. And then when COVID hit, that's exactly where the VIX went again. And so this time around, remember, it was October 2022. We didn't even come close to... This is my line right here from 2009 to 2021. This is just where corrections. Every other drop, even the drop we had from, even though technically it met the bear market criteria from the 2020, late 2021, early 2022 highs, the drop in the markets. Again, I'm considering a first leg down in a bear market. But it was by every metric in the book well into, I think the S&P dropped, 36%, maybe something like that. I don't know. But it didn't even get the VIX to where corrections, these are all the big corrections, including the big Q4 2018 drop and the other ones, and that's where COVID ended. We didn't even get that far. And that is one thing that tells me this bear ain't over. I use that quote. I love the quote from the movie The Usual Suspects. Kaiser Soze, played by, wasn't it Kevin Spacey, his character, said the greatest trick that devil ever pulled was convincing everyone he didn't exist. And I think that's this bear market will go down in history. It'll be the greatest trick it ever pulled because, as of just a few weeks ago, at least, the vast majority were convinced that there was no bear, the bear was over. All right, so we'll see. And again, these are the things. I'm, showing you these charts, explaining all this. So go down to the daily chart, and I've been talking about, VIX looking good lately, meaning objective long. We had a divergent low. Look, we had a divergent low here. For all those naysayers. It's funny. What's funny is there's been a few people vocal on the comment section the last couple of weeks about these divergent highs, almost like out of anger. First of all, again, when I point out divergences, if I will follow up and tell you where the sell signals are, what levels need to break, and then when you get a sell signal, the next level. A lot of these have been, the market's been kind of grinding sideways. It's been a trader's market. You may cover those shorts, maybe get long, wait for the next sell signal, go short again, or if you're scaling into a longer term short position, don't go all in until my key purple levels get taken out on the FANG. So there's, anybody just shorting and throwing away the key right now for the last, for really in any time in 2023, there's no reason. But where I'm going is there's been plenty of divergent lows pointed out. And these are also, these divergent lows in the VIX coincide with divergent highs in the stock market. And so the VIX, these are the little trading vehicles. The VIX to me, it's like an irregular EKG. You look at EKG, electrocardiogram monitor for the heart, you're going to get these spikes. And so it's very, very lucrative to trade. And again, one of these, with these divergences getting bigger and bigger, that one to me had the potential to be the one that takes us up to those, keep going up and to where the bear markets used to get to and will again at some point. This one has the potential. And here's the thing, guys. So, that was a objective time to go long the VIX. The VIX itself, you have to trade one of the VIX tracking instruments like futures, options, or the ETNs that roll the futures. That was a 46, almost a 50% spike. This one off this divergent low was a 81% spike. And this is an even bigger divergent low. So there is no guarantee, no set formula. But typically, not always, the bigger the divergence, bigger. This is the same divergence, guys. That's what I'm trying to say. This is just the same divergence getting bigger when your security keeps making lower lows and the indicators keep making higher lows. That's bigger divergence. Typically, the bigger the run. So if we had 50 and then 80 something, my next target, I think this one has the potential easily to play out up here to this downtrend line and that 29-ish resistance level. And if so, then that's going to be a run of, I'll just grab a little below where we bottomed and then let's take it a hair higher. That's about 143%. It's, there. Pretty big resistance we're coming up on. And so the way this works too is I have resistance. This is a pretty decent level at about 1573. I think if that's popped, that will most likely coincide with a breakdown of the levels that I've covered with you on SPY and QQQ, levels that we need to take out to open the next leg down. And so that would also be an objective time to add on, take a new position. Again, you have to take it collectively, because let's just say the VIX pops 1573 and you're only trading the VIX in a vacuum. But at the same very time, QQQ and or SPY or Apple and Microsoft, they fall to support and the buyers step in and buy those. The market goes up, that breakout in the VIX is going to fail. So you want to align all this. This is why I do these videos, and to analyze the VIX without analyzing the S&P 500, without taking into account the Mag 7, QQQ, you're really doing injustice. Just like I will always include the euro and US dollar in my analysis, and gold and silver, and in my trading, and GDX as well, because that has a huge impact on the direction of gold and silver. Alrighty, next up, that's the markets. Oh yeah, semis. Let's go there. Kind of a subsector of the tech sector, which is most of what the NASDAQ 100 is. So there's some vocal comments about NVIDIA. I don't know if you're short NVIDIA. I'm not short NVIDIA, but I am short the semis. And somebody said, well, the semis just keep going up and the Mag 7 going up. Well, first of all, no, the Mag 7, everything's dropped lately. These divergences are playing out. So let's look at this. Now, the SOX is, I'll cover the SOX most, SOXX. The SOX is the PHLX SOX Semiconductor Index Sector ETF. That's because there's the SOX index has been around forever. That's this one right here. Here's the actual index. It was the original semiconductor index, and on your charting platforms, because it's been around since semis were really started to become a big thing back in the 90s. And so that is one I'll often track, but keep in mind it has its shortcomings like all indexes. And so there's SOXX. That is at a new high, still a divergent high. The last time we had a big divergent, well, when we had this divergent high back here that peaked in November when the tech sector and NASDAQ did, the semis fell 50%. So if you were bullish back then and singing this song that divergences don't matter, and you just held on, then you lost half your money in the semis down to that point. They ended with a divergent low. That was a catalyst for the rally. They had a divergent high right here, which pointed out. We traded. So we've been long and short the semis along the way here. And all these trends, not each and every one did I post or catch personally, but a lot of them. And so including this one here, and I'll show you a couple in a second. But there it is. So off this last divergent high right here, again, it's not as if it didn't work. And again, divergence, I always say, is not a sell signal. What is and was back then, I highlighted, we had a breakdown of this uptrend line, this bearish rising wedge here. We back tested, stuck with it, and we went on, and I had multiple targets. I think it was on a 60-minute time frame. We traded down to impunity, hit the bottom, covered, and reversed. And so I say this because it's just a little frustrating. If new folks are coming to the site and you hear these people that are, either veiled or direct, saying, oh, you can shorten all these divergences, getting killed. I'm not. In fact, here's the charts. Let's take a look at those. And these were on the site, covered in these videos, and even in this case, static charts. Usually 99, or not 99, well over half of the charts and analysis I cover, probably 70, 80%, are in these videos, and then when I can, I mark up the individual charts for you. So this was it. So we shorted here, and then we hit T1. We shorted off that divergent high. We had multiple sell signals. I think that was the first one. Then we back tested on the daily and then had additional sell signals. We made a marginal new and still divergent high. We swung it down. We hit T1, which I pointed out at the time. Again, I list multiple targets because those are levels you're likely to get a reaction. If you traded it, that was probably double digits, 10% or more. I can't measure. This is the screenshot from my chart I posted on October 25th when T2 was hit. And so there it was. So you would have shorted that down, caught the biggest drop in the semis in years. And with impunity, when T2 was hit at 44, 45.70, I always say cover a hair above. You don't want to hold out for the last, 1/10 of 1%. It's ridiculous because quite often the buyers will see that level like I do and step in early. And so I had us going here and then to the trend line and then down. And so that was back on again, October 25th. And then this one's November 3rd right here. You can see it here, November 3rd on the screenshot and the date down on the bottom. I'm sorry, my mistake when I said with impunity, we went a hair lower, 445.70. We went down, which was well within any reasonable stop. And we were approaching the downtrend line, so I was giving you a heads up there. So, and again, why? Was it random? No, it was a lot. It was support was hit. We had positive divergence. And keep in mind, guys, SOX is one of 3 ETFs. I'm going to cover the rest here in a second. So, again, this is swing trading. This is not. I haven't seen enough evidence, and I've been talking about this for months, those purple lines, those key support levels on the FANGs, which were the same levels we got long right before the market ripped into year end. That was the case to cover all shorts. I posted that going long. Again, I'm talking about when QQQ and the semis were right here. That was it. QQQ was also at support. So now let me show you the other semiconductor ETFs. So here's the thing about SOX. It's chock full of NVIDIA. I don't know the weightings offhand. I had it at some point. I noted them and had them written down. I guess they're not on here. But you have the negative divergence. And some of these semiconductor ETFs, particularly SOX and SMH, there's 3 big ones. SOX, SMH, which is from a company called Van Ectors. Again, they're semiconductor sector ETFs. They just have a different weightings, different baskets of the semis in there. I don't know if that's a valid trend line. I might just put that there now. But you can see a clear wedge right here on this one. Negative divergence, divergent high. First of all, the semis you roll back. This one's a little higher than its peak back in late 2021. SOX is about right there. And then I'm going to show you a more diversified one in a second. But they're all, pointing to the same thing. They all have big negative divergence, especially on the weekly chart. I recently gave you I've given you the targets on SOXX on the weekly chart here. We hit T1 there, came a little shy of T2 there, and I'm still looking for, move all the way down here. I'm looking for another 50% plus chop on the semis, and I know I'm probably the only person in the world, especially with the CHIPS Act, looking for such an aggressive downside target. And again, it's the charts tell me that's, I know it's a strong fundamental headwind. I absolutely would not bet the farm on it, and I absolutely wouldn't fall in love with it. Maybe these divergences do get burned out, and there's a ton of money that still hasn't been deployed yet from the CHIPS Act, from what I hear. So we'll see. We'll see where it goes. But I'm a believer in the charts over fundamentals and rhetoric. And also you have to ask yourself how much of the move here, how much of this almost 100% rally in the semis over the last year or so has priced in the impact that the CHIPS Act is going to have. That's one thing you have to always ask yourself about stocks. By the time you read about something in the paper or hear about it, quite often, most, if not all of that's been priced in. So finally, and then I will end it here for the semis at least, at XSD. This is a more diversified. This one I know doesn't have such overweighting. The problem with those other two, they're a lot like QQQ, in regards to the big Mag 7, where those 7 stocks make up over half the returns of the entire index, right? You don't have that in this one. So this gives you kind of a broad, a more accurate history, if you will, of the entire semiconductor sector. And it peaked back in 2021. And so you can see so far we have a double top here, but we're still well below the late 2021 highs in XSD. And then you zoom in more recently, you can see that was a divergent high. There was your sell signal. That's when we shorted, back test, stuck with it, added, highlighted, covered that, and that's when it was SOXX we covered. Either one, you could have traded this one. And that's the rally up. So we were short here at the highs, rode it down, almost milked every penny, reversed just a hair shy, rode it up, not all the way up, but now threw it out as a short trade idea again recently. And so this is, here's where we're at on XSD. 207, we're going to call it. I'm going to round down. Nice support. It was resistance, resistance, resistance. Broke out here, ran, back tested it, new highs, came back, cut through it. I will give it that. It's not been the best level. Well, there was a couple slice throughs there, but then once we gave it up clearly, big drop, rally back up, broke out again. We're back testing it. So this is a battleground, if you will. And if we clearly take that out, clearly is not 207.41, 207.39. It's we get down here. Probably, I'll tell you, it'll probably do the trick. Is break much below today's lows should do the trick, or about 204. I see a few reaction highs there, and then that should help seal the deal. But you can see this was already the divergent high, then the breakdown, little kickback rally, and so that's how the semis look right now, guys. Oh, and then what do we jump down to the 60-minute chart. This is SOXX. Here's our divergent high right here. Our most recent high was a divergent high, and got a nice clean trend line. So you want to watch this if you are looking to short, or if you're a bull, you can buy. Now, I don't buy pullbacks to a rising wedge. This could certainly go up like this. We could wedge a little higher here. But as you can see, this was a divergent high right here. There was negative divergence at this point. That was a divergent high. This wedge looks ripe to break down. It could certainly have another thrust up. Either way, I have price support or resistance, about 563 on SOXX. I can put in a few more lines here. Yeah, a little trading range right here we need to punch through, and then that should open the door for more downside. There's your first target, our next target, 524.50. And we do even have, after the breakdown, we have a little divergent high right here. So anyways, that should do the trick. Under 550 should take us down. And then let's look at the others. Let's do that to make it safe. XSD, beautiful, clean, bearish rising wedge. That's a divergent high, negative divergence. We fell. That's pretty good support. We're on it now. And we also have, which I need to note, that's why we can't get crazy short right now, we have a positive divergence, potential divergence. Now they can take that divergence out. If we break down and we keep moving lower, your next support there is right there. So these are your levels. And we take out the 196 support, the divergence will be gone. And I already showed it to you on the daily chart. That's what it looked like there. And I give you those targets. And then the other one was SMH. Let's just look at the 60. Well, on the daily, you have that uptrend line right there. On the 60, is how I had it drawn, a trend line there. I don't... Yeah. I think this trend line will come into play. There's enough reactions, a minimum amount for me. 3, 1, 2, 3 right there. And so, yeah, it's a big bearish rising wedge, divergent. We had divergence here. It's not as if it didn't work. That divergent high, that first one was good for about a 7.5% drop. And that divergence is only extended at this point, indicating a much larger drop to come. Support and or a target right there, 165.32. And to be safe, you've got another little bit level at the bottom there, right under that reaction low. So this is what gets needed. That's what needs to be taken out to open the door for a bigger move in the semis. So that's what I suspect will happen. Boom, boom, boom. All right, I'm looking at the counter here, and I'm already 49 minutes into this, but I promised a subscriber an update on gold and silver. I don't have a strong opinion right now, but we are coming off these divergent highs. We did have a divergent low recently, popped it, but look, we already faded that pop. We still have positive divergence right now. Remember, positive divergence is not a buy signal, just like negative divergence is not a sell signal. Reason I'm not digging gold so much is the euro. I can't make a strong case right now. Before I did for a bounce in the euro, and we bounced in the euro, but the euro's come back down. And I'm going to go to the futures too in a second. Silver's up at really good support. So I think it'll probably bounce again. And I think this, no, I know this is an objective entry based solely on this chart. If I had a super high degree of confidence, I would need to see the euro and be able to make a very strong case for a bounce in the euro, pull back in the dollar. But I can tell you this is a objective to go long here, 2062, with a stop somewhat below. Somewhat depends on where you think it's going. These are all potential targets. Every line on this chart right here, including this one all the way up here at 2390, that previous high right there, those are all potential targets. You can see wash, rinse, repeat. Divergent low off support, rally, right? Divergent low, give me my arrow tool, rally, divergent low, rally, divergent high correction, divergent low, rally, divergent high correction, divergent low. And all these divergent lows except this one punched through. There was a false breakdown, but we had a divergent low, we rallied. But you can see a lot of reactions on this level. Some punch through, that's the nature of the game. Sometimes they're going to stop you out and reverse. You can't bat 1,000. Nobody bats 1,000 in this game. But all you can do is take objective shots. Now, the fact it broke out and failed, so far fell back, I'm not crazy about it. And again, I'm pointing it out. And you know what? I might even take some of this right after I stop this video. I might get back. I've been trading in and out of silver lately. Platinum actually looks pretty, palladium looks pretty good right now. There's that same support level on silver. But again, gold is the big brother to silver. Silver is going to follow gold. Gold's also at support on the daily, minor support. And then most importantly, I know the video is getting long, but I have to cover the euro, US dollar. I can change these trend lines around. This is a primary, very important trend line that I told you back here weeks ago, if not months ago. I got bearish on the euro US dollar, bearish on gold, predicted gold would fall because you had, on the 6th, you had a sell signal there. You had a divergent high and we fell. Then that's a secondary trend line I have, which we've now taken out. And if you look back, go back a month, 2 months, I've been calling for a move down to this level. If that happens, guys, I don't have time right now to do it. If you haven't seen me, I've done it 1,000 times. Overlay, do it yourself. Pull a chart of the euro. You can do FXE for the euro ETF and then overlay GLD. And you will see they have a super, super strong positive correlation, meaning they move in the same direction, which means gold and the dollar means they move in opposite directions. So when the euro US dollar pair is falling, or just the euro is falling against the dollar, gold will go down almost every time, especially in the larger trends. Again, you can verify that if you don't take my word for it. And so therefore, there is some support here. So again, my convictions aren't super strong. Probably get a bounce here. Could be more than that. Like I said, silver I like better than gold right now. It's that support. But the problem is gold's going to need to rally. Rarely are you going to see gold falling substantially and then silver going up. So keep that in mind. So kind of a meh, like a soft entry or pass if you want a higher probability trade. But I do think silver is probably going to bounce one more time off that support level. Or heck, you can short it. I just don't like shorting pullbacks to support. I'm talking about silver again, and with positive divergence. It just goes against my nature. This is gold futures GC. You can see, remember, we had positive divergence, popped, took out the downtrend line, but it went nowhere, got sold into. There's still positive divergence, but just the price action again. Why? Because of euro. So this is an example where I made a bullish case for gold and broke out, and I highlighted it, but it ran into that. Remember, this is the same chart I gave you, the same levels. It hit the highest level, resistance level I had on that chart, and that's where it stopped, and it's sold off since then. So it needs a giddy up soon. Reverse, or the divergence gets taken out, and then it gets harder for me to make a case. And until unless, of course, the euro gets down to those levels I showed you a minute ago, that primary uptrend line. And this is silver futures. The GC, I was just on gold futures. You can see here that was divergent low, and then a breakout, rallied, hit that 23.73. These are all targets I gave you before on it. Hit that one to the button, reversed. So if an active trader, you could have booked profits there, or at least raised stops if you were holding out for more, and then you would have protected gains. So we've come back to that 22.75-ish level, support. We had one little whipsaw down through it. Even go back 6 months, I think you can even see more of a support around that level right there. Last but not least, just want to do an update on treasuries. So, well, let me segue in from the euro I was just covering. So you see this? There's the drop in the euro right there that I don't think the market's been pricing in. I'm going to show you that. Here, let's go to a different board here. Okay, said I wouldn't do it, but I think I need to here to just clarify, and then we'll wrap this video. It's been long enough, but probably the only one I need to get out to you today, unless I see something else. This is FXE, and I'm not using EURUSD because it trades 24/7. Gold, GLD, or no, QQQ, or the ETFs. This is QQQ in purple. It trades with in the same time frame, 9:30 to 4, as FXE, which is an ETN that tracks the euro to show you. And again, the euro is just the upside down dollar. It's the largest component of the dollar index, so that's how that works. And it's just easier to put positive correlations, show them on a chart, than inverse correlations. Inverse correlations are a little harder to spot out. And again, you don't want to see, the lines don't have to overlap, nor can they or will they ever, because QQQ moves up and down much more in percentage terms. Remember, currencies are traded in pips. A pip is 0.000 out to the third decimal, or what is it, fourth decimal, whatever it is, because there's hardly any percentage fluctuation in currencies. So QQQ, or the stock market, is going to move up and down a lot more. What you want to look at are the trends. Are they both rising at the same time and then falling? Look for the peaks, look for the turns. And you will see an almost perfect correlation. There are temporary periods where they disconnect, but those are also opportunities, because usually there's a mean reversion. And that's what I wanted to point out here, and I've been talking about this. So what's happened lately is the euro has been falling substantially. In the stock market, they both peaked right here, but the stock market almost made, or QQQ at least, almost made an equal high. So it hasn't gotten the memo. One of two things is going to happen. Either the euro will rally, and means the dollar starts to fall, and that's bullish for stocks, and then that might give us another thrust up in the stock market, or it goes the other way, that the market gets a memo, hey guys, euro's been falling, and that is bearish for the stock market. And the other one is, I'll leave FXE up, which is the euro in white, and then show you, oh no, need to change it, Treasury bonds. So TLT is the 30-year bond. We can look at the 30, or you can look at the 10, which is IEF, but you can see the same thing, in unmistakable correlation between bonds and the stock market. And that is because when TLT is going down, rates are going up, and that is bearish for stocks. So all along here, again, I have TLT in white. Rates were falling. Bonds were falling, rates were going up, my bad. So the stock market was falling as well. They bottomed right there. And that's when bonds peaked out and the stock market bottomed. And then boom, they both rallied up. Again, they don't move in the same percentage term. Look at the directional trend. Most important now is we've seen a substantial, and I called for it, and we've been short Treasury bonds, a considerable drop in bonds. That means yields have been going up, bond prices going down. And again, so far the market did peak when yields bottomed and bonds peaked, bond prices. However, it's not been reflected because the QQQ and you could probably do SPY have come back up, and so this is the disconnect I'm talking about. So one of two things is going to happen. Either yields will start to abate, and I don't think so because I still have, if you recall, TLT. Remember, we've been short here. We had a trend line break. That was our sell signal, divergent high. We've been moving lower. We haven't even hit my first target. So if we continue down at some point, and I think it's incremental from here, but also incremental and exponential, if you will, or you'll see an increasing sensitivity, more and more talk, more and more bobbleheads coming out on TV, more and more selling from market participants of equities that's saying, hey, wait, what's going on? Right now, the market's just chalking this off up to just a correction in an ongoing uptrend in bonds. But I think that correction has more to go, especially if we come down to my second or potential third target zone. That's where you'll really see the market start to throw a hissy fit. It will not like that because you're getting close to those October lows in bonds. So I can't promise we're going to get there. I have a pretty good degree of confidence we'll get to at least my first target. And like I said, it should be from here because of that recent divergence. I think every little tick lower in TLT and IEF, you really want to watch IEF as well. That's the 10-year. Coming up on support right now. You can see, oops, I had dual support levels. And maybe this is what the market's anticipating, that the 10-year right here, IEF, is going to bounce. You have 94.87 price support. It's that key reaction high and uptrend line support. Remember, we had this bearish rising wedge. This was a reason to expect a pullback in bonds and a uptick in rates. And the million-dollar question, does the market get this? The market will like that. The market will not. I promise you the market will not like that, the stock market. And, whether we bounce here or not, I think we're going to get that. So there it is, guys. A lot of stuff, but it's all, to me, about the big three: bonds, i.e. interest rates, currencies, i.e. the US dollar and or you can look at the euro, and then stocks. And so I trade them all together collectively. And, break of these support levels in bonds, which would be breakout in yields. You can flip it over and look at TYX and TNX will be the next sell signal in bonds, bringing rates higher, and I think it'll really put the brakes on the stock market when that happens. Like I said, I think it's been the market's been dangerously ignoring this uptick in rates. Again, just dismissing it as just a brief counter trend move that's likely to end. But if it doesn't, and I think that'll be soon, the market will realize, uh-oh. I will stop it here. One of those super long videos, just over an hour. But again, guys, you can always play these back. I do it when I watch a YouTube video. I increase the speed to 1.5 to 1.75 times, and it'll cut down on the time frame. Hopefully you find this useful, and I'm going to end this one here. And if I see any other opportunities, I'll get them out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.